I also did say, Ian, that we could still end 2023 positive year over year since we ended at 525. Now, the Austin numbers haven't come out yet. It's the 13th. They'll probably come out Friday. Yeah. So still, and Aaron says still not a technical recession. We have white collar jobs being lost left and right. Very true. But lots of low paying jobs. Those low paying jobs still increase the GDP. Well, that goes exactly back to what we were talking about. We saw people's income drop $2,000, right? From 76,000 to 73,000, something around there, 74. So that is a interest. So one thing about this, Ian, if people are trying to buy, they're looking for alternative ways to buy right now. And one thing that's starting to creep up is a lot of people, in fact, people asked last week on the show was, can I do an assumable loan?
Assumable, yes.
So there's a real estate company out there that's starting to try to figure out assumable loans. And there's this article out by the Wall Street Journal. Other ways of buy, Aaron's looking at a 3-2-1 buy down. I think this is a pretty solid plan. You know what you're getting into. What a 3-2-1 buy down. Do you know what a 3-2-1 buy down is, Ian? You want to explain it while I pull up the article?
Yeah, I guess the best way to explain it is that you're locking in the rate. You're locking in a mortgage rate, and it staggers downward, hoping that you're hoping that the mortgage rate is going to lower over time. That's what you're banking on. Then the question is, do we think that's going to happen? And I think everyone is leaning toward yes. So It's not good to do something like that if you think that the rate is going to creep up.
So 3-2-1 buy down is definitely a decent way to go. I have a 10-1 on one of my loans. So, but it just takes you back to whatever the market rate was at the end of it. Oh, here we go. I got it right here. Perfect.
And the important part is that on the third one, it should lock that rate in. But you also want to hope that you have a chance to refinance before then.
Yeah. So Aaron says it lets me bet that in 3 years the rates will be lower. And he says, and it's adjusts up 1% for 299, 399, 499% interest rate. So I think that's a smart way to go. I've had quite a few clients that are doing that as well. Here's what we're talking about. I had it right here. So a 3% mortgage rate is in a 7% world. This startup says it can do that. So this brokerage that's starting up basically wants to try to get people to do assumable loans. And so there's a lot of people that have mortgages right now that are 2.5%, 3%. But when you think about assumable loans are loans that are backed by government agencies. So FHA loans, VA loans. And so so what they're saying is that if you, a buyer, want to come in and get an assumable loan, we find an FHA property that has assumable loan. You come in, give the seller a little bit of money. They walk away from it. The bank then converts that loan over to you, and then boom. It all sounds really, really great and easy in theory. This article kind of breaks down why it may not be the best way to go. It says, in theory, the idea sounds great, at least for discouraged home. Oh, God, dude. I'm dying. It's been such a long day.
I'm a little rough.
All right. Start again. In theory, the idea sounds great, at least for discouraged home hunters who can inherit a low rate loan. Sellers in turn might fetch higher prices for their homes. I don't know that they're necessarily going to get higher prices, but Rome's vision faces an uphill battle. Go ahead.
Yeah. So you got to think about what the seller is saying is that they'll give you their loan at, let's say it's a 2 or 3% rate. So that's what you're buying. So sellers think that they'd be able to charge you more, or you would pay more for the home because of that.
Right.
But you have to be careful because the amount of homes that can be assumed, so like VA is a great example. You can't just assume a VA loan unless you have VA eligibility yourself.
Well, right? And then if you assume a VA loan, the person that just gave up the VA loan can't go get a new VA loan right after that.
Correct. And unless it's within their limit, right?
Yeah, and that's ridiculous.
Yeah.
Florida, I'm going to get to your thing in a second here. But Rome's vision faces an uphill battle. Loan assumptions haven't gained much traction recently, even though rates are up.
So
It's funny because they say this is partly to do that lenders don't want to deal with them
I
because
was going
they
to
don't
ask,
get enough money from them.
if they don't make enough money and there's no education around them, then I can see that being an issue. But this could be a really good opportunity for agents to share that with their clients, both buyers and sellers,
Yeah,
as an option. But also, like you said, there are a lot of limitations on it too.
right. And so for those people that think they can just jump in and do an assumable loan, here's what it says. A loan assumption is different from a standard sale in which a buyer takes out a mortgage at the going rate from the seller and at the going rate to pay the seller. In that case, a seller uses the money to pay off his or her mortgage and pockets the rest. An assumable transaction doesn't replace an old mortgage with a new one, but instead transfer the old mortgage to the new owner. Again, you also have to qualify for that as well. The seller is relieved of the remaining mortgage liability, so the balance is subtracted from the purchase amount owed. The buyer can come up with cash to cover the rest. Now, this is where it gets tricky and why it's not going to make sense for a lot of people. So it says take a $500,000 house that is tied to assumable mortgage with a $300,000 balance. Even after the buyer assumes the mortgage, the buyer still needs to come up with $200,000 in this scenario. Unless the buyer can pay that amount, he or she will need to take on a second mortgage. So if they're doing like 100% financing on something like this, now you're back into the days of why people got in trouble back in 2008, 2007. They were doing 100% loans on a lot of properties. Rome says that it will recommend lenders to provide additional financing. It wouldn't specify which lenders it would be working with. And here's the thing. Rome got $1.25 million in seed funding to work this out. And the people that are backing him are Open Door and some of these other places. So I mean, it sounds good in theory. If you're looking to do an assumable loan, there's a lot of pitfalls to it. If you can make it work, I think it's a great way to try to do it, but I don't think it's going to be for everybody. I think it's going to be not for a lot of people. What do you think, Ian?
Yeah, I think if you look at how much the seller would require down in order to allow you to take their mortgage from them, if you're talking FHA, how many people are going to be able to take 200,000 and put it down toward a house? Usually FHA is not quite so liberated.
Yeah. And this is one thing Aaron says too. People are missing the point on loans, though. You aren't thinking about amortization properly. Does the rate even matter? You pay most of the interest in the first 7 years. It is really about the payment.
Absolutely.
But let's see, with rates being that high and prices still being high, people are still forced with that. Thanks for watching this short of the Real Amigos podcast. For more live streams, hit here. For more clips, hit here. We'll catch you on the next one.